Welcome. I'm Catherine Magana here with Steve Wolf, Rachel Ivanovich, and Greg Carroll. And today we're here to provide you some insights, just a little bit about the markets, but today is more of a special edition. Today is June 30th, and this week is 4th of July week. With that, the stock market closes early on Thursday, and then we're closed on Friday. So during that time, usually what we see with the markets, not as much trading because a lot of people are traveling or on vacation. But I thought I'd share some kind of historical market returns the week of the 4th of July. So historically, it's a bullish week. The week of the 4th of July has generally been bullish with over the last 50 years, with an average return of 0.52% for the S&P. Yeah.
So
yes. And then strong performance.
Hey, you know what? That's better than being down.
There you go. Yes, exactly. I'll take any update any day, any week. And then strong performance in years. Basically, the S&P has been up over 10% the first half of the year, and the 4th of July week has been even stronger with an average of 0.93% positive returns 79% of the time. So once again, if the S&P was up over 10%, then we'd see a higher return this week. We're not seeing the S&P 500 over 10% this year. And then just remember, past performance is not indicative of future returns, and this is just some historical, fun information to share with you.
You're not guaranteeing this?
No guarantees. That's for you, Matt. So just a quick update. I know we did kind of a big market update last week, but as of Friday, June 27th, the Dow Jones was up year-to-date 3%. The NASDAQ up 4.99, and the S&P 500 4.96. And the Russell 2000, which is still down, but it's come up a little bit, but it's down 2.58% this year. So the markets have come up a little bit just in the last few days, and today's the last day of the trading month. It's actually the end of the quarter. It's mid-year. I mean, there's a lot.
Are we going to get a tax bill is the big question.
Yes, and that's something that, we're hearing.
Are they going to hit the deadline by the 4th? That's what
they're working
wants
hard
to know.
right now. They're working hard. My guess
they
is
want
they
their
don't.
Vacation.
Yeah, my guess is that they don't get it by the 4th, but we'll see.
I don't think so either.
You don't think? I don't know. I guess they
all want to
don't
go
they
on
say
vacation.
right? So we'll see what happens.
Trump has a way to pressure them. So. Well, didn't they just pass? The Senate just pass it back to the House?
Yeah, I think so.
So that's a big deal.
Mm-hmm.
Yeah.
We'll see. And
then the odds of a July rate cut is about 21%, so it hasn't changed too much. And then for September, we're looking at 93% chance of a Fed cut. So we'll see. We've been talking about that for a while. Well, I know that's been priced in for a couple rate cuts, but we'll see what happens between now and then. So shifting gears a little bit, I think we kind of wanted to talk a little bit today about some of the clients that we work with. And one of the topics kind of mid-year that comes up, not only kind of doing portfolio reviews, but also it's a good time to look at your estate and kind of make sure your beneficiaries are in order, or do you need to make any updates to your wills and trust? And it's interesting. I'm about to travel with some family. And before I was leaving, I was like, oh, let me take a look at my trust. And my sister, who's my executor, is actually going to be with us on this trip. And I thought, wow, interesting. So something happens to all of us.
Same flight?
Yeah, same.
Yeah.
Some of the same flights. And so we had to make an adjustment there. And then also, anyway, long story short, we had to make some adjustments to if something happens. And we don't, I expect to be back, after our trip. Right. But you just obviously make sure everything's in order. And so also what comes up a lot right now is, a lot of clients are talking about kind of their IRAs and checking their beneficiaries. And
I had a conversation this morning with one. They wanted to know, should I be leaving my IRA to my estate or directly to my beneficiaries? And we had a very nice discussion about that. But if you leave your IRA to your estate, the tax implications might be worse. So definitely make sure that you're checking in with your advisors on that.
Unless maybe if they're minors. Right?
True.
Yes. Yeah.
That's one
So definitely
it's
it's
a into your
case-by-case situation.
Yep.
But definitely want to have that good discussion.
Yeah. One of the things I've come across over the last couple of years a lot is newfound wealth. When people, get windfalls, a lot of times from inheritances or selling a business, receiving money is really an emotional and a financially daunting experience for a lot of people. Unexpected financial gains, whether from, like I said, the sale of a business, a home, retirement account, receiving a sizable estate can result in snap decisions, lost opportunities, expensive errors, when it comes to assisting recipients in moving from this emotional response to more of a deliberate preparation, advisors play a critical role. Some of the things that we can do is really encourage a pause. I see so many people that they get the money and they've got all these grand ideas.
Yeah.
I mean, I had one client a few years ago was going to build a ADU, put a workshop in his garage, throw solar on the roof, and I mean, 50% of that estate was gone within less than 2 years.
Well, not if they would have hired Rachel and her husband Cole to do the
To do the demolition.
The 10-year install.
Exactly.
because they've done their own. So
have you listed this outside business activity yet?
We're thinking about it.
Well, it's interesting you say that with clients inheriting money. We actually had a client, both of her parents died within a week of each other, and she inherited a big windfall of money. And she had never, made that much in her life, and she had enough to really kind of retire. But we did a plan for her, and we looked and said, okay, how is this going to last? And so she was really mindful. Like, she didn't do the big trips in the car. I mean, she was like, okay, I want this to last for the rest of my life. And so we put together the plan, and we had our budget and expenses. And well, unfortunately, she ended up falling terminally ill within a year and passed away. And I was thinking, here we had this huge plan. Like, maybe you should have spent a little bit. No, I know, but I think peace of mind knowing that she had enough. It was going to last. It just, unfortunately, it was a terminal illness. But I just thinking, and I kind of said, maybe I should have, told her to spend a little more.
Yeah, I'm going through a client that's selling a business right now, and we're doing all that planning before they get the money. But it is a big step in a different direction for them. Yeah. What are they going to do with their time? How much do they, what are they going to do? What's the budget for travel? And
did they meet with their tax advisor? I hope so.
They want to talk to you, Rachel.
Okay, go. It's like, yes, because I don't want to hear after the fact.
Yes, so that's part
Let's
of
do the
the
planning now before they sell.
Yeah. Well, that's too late.
That's another podcast.
That,
they already sold it.
It's like today.
All
right. Okay. Well, tell them congratulations.
Well, if inheriting that money is really too traumatic for all those people,
I think Steve's accepting.
I will accept any and all. No, I can't do that. Only kidding. I can't.
Can't do that.
But it is a big thing, tax wise. You need to understand, stepped up basis.
Well, we were having that discussion this morning with his client, and he has, as part of his portfolio, he has a lot of real estate, but then he also has an IRA and wanted to leave money to children and to charity. And so the question is, what made most sense tax-wise? And so if he were to give the IRA to charity, they're not going to pay the tax because they're an exempt organization. The children, his adult children, would have, but the real estate, that gets a stepped-up basis. So they could choose to keep it rented and have that income, but they would still have that advantage of the stepped-up basis, and it steps up for depreciation as well. So
you recoup all of that.
It's nice. Well, you get that additional deduction on their taxes.
You're kind of segueing into something that we see all the time. Recently, we had one of our clients pass away, and the kids have decided that they're going to manage this on their own, and we seem to get a lot of that type of thing. But there's nothing. Some people are great at doing it themselves, and if you have experience, and not everybody needs an advisor. But I got to tell you, the do-it-yourselfers miss out on a lot of things that we do. You just mentioned some things on tax preparation. Behavioral coaching. We talk about that. How many times do we get calls from people at the bottom of the market saying, "Get me out, get me out." And
or at the top, buy.
Right, and that's usually what happens, because the Uber driver said that I was going to say taxi driver, I don't think there's any taxis left, but the Uber driver said to invest something, and so they're wanting to do that. Holistic planning, tax optimization.
Absolutely. See it all the time where somebody does their taxes themselves, and then they have to come in and have me fix it later on.
Right, so I mean, you think you're spending money, but you're really saving money in the long run for most people, not everybody.
I amended their return. They would have paid me maybe $600. I got them $8,000 back. So don't do it.
Pretty
yourself.
good return on your investment.
That's what I thought.
Yeah.
Should have charged more.
Other things that they don't get, risk management. Although. Again, there's some do-it-yourselfers who know how to allocate properly. A lot don't.
Yeah. Well, it's interesting. We had a client that came on board with us last year, but we had a conversation a few years ago, and they had some concentrated positions. And so, great, the market was up, but then eventually they realized, I need some help. It's one thing to put money in a couple of stocks, but the reality is he finally realized he needed a little more guidance, and it's not just, hey, I can buy one stock. We also have another client that we're working with. She was a little bit of a do-it-yourselfer, but now she's so busy. She's like, I don't have time to research and follow the markets, and then she has accounts everywhere. I mean, she has stuff all over the place. So we're helping her consolidate, organize, and get more of a plan in place. And so I think there are pros and cons. I mean, if you really want to spend your time, researching and putting together the investments, and there's a lot of for us, it's there's a lot of moving parts and strategy, like you mentioned, the tax planning part of it, and there's some other types of investments we incorporate also if you're in retirement.
Most people don't realize how much time we actually spend researching things.
Right.
It's not just a matter of buy this or sell that. Before we do any of that, we're spending tons and tons of time researching. Some other things that they don't get, withdrawal strategies, like sequencing, their withdrawals for retirement income. Sometimes the do-it-yourselfers just look at that 4% rule to get their money out. Maybe that's okay, but maybe it's not. Legislation and rule changes happen, and they don't know about it. I know you talk about that all the time with taxes.
Absolutely.
Behavior biases. I mean, we all have them. Are you one of those people that will invest in something because of your bias? Account consolidation, legacy and estate planning, which we've touched on, and then again, what Catherine said, peace of mind and time savings. Do you really want to do all this?
Yeah.
I mean, for the amount it takes to do it right, most people don't want to. And again, not every investor needs an advisor.
Yeah.
Okay, we're not saying that. Some do a great job on their own, but many who think they're saving money by doing it to yourself are really not.
So it's interesting. Over the last several years, there's a lot of clients that we work with that perhaps the husband was more involved and kind of was your do-it-yourselfer, and then they realized, I want my spouse involved, and so now we've opened up that door and said, okay, let's have these conversations together, because they view money a little differently, or they just want to make sure they have we're here with that other voice, making sure that they have a plan that's in place. And so we've seen a shift, especially some of the couples that are out there and their husbands want their wives to learn and be involved. And so that's something, especially if you're in retirement or you're looking at your estate plan, and making sure you have a trusted team available to you.
Except for those husbands that are really thinking about divorcing their wives.
No.
And then they hide everything, right?
No.
Well, we've seen that.
I've seen it.
We've seen it.
Well, I've seen it the other way too. So
Yeah. Where the wife hides it?
where the wife hides it. Mhm.
Interesting.
Really?
Okay.
Wow.
I haven't come across that one yet.
Seeing a trend where women are making more money
That's true,
than
and-
men. With
So that makes sense.
And so, yeah, it's very interesting.
Yeah,
Maybe-
a lot
maybe I
of
need-
friends and clients, the women is the breadwinner. So, yeah.
And that's a big change. I mean,
It is.
that has changed dramatically in the past 50 years.
I have a lot of clients, they stay home, the husband stays home with the kids, and the wife is one who works.
Yep.
Right.
I've had a couple of those.
So why are we still thinking that women are second-class citizens? We're
not.
We're not.
I say we, meaning let me explain.
Okay.
How we have people who are complaining that women don't have equal rights and all that kind of stuff. I don't think that's true anymore.
Well, there's probably still some pay inequality out there for similar.
I think we recorded a podcast on that.
We did a couple months ago, and even in our industry, we're starting to see more female advisors and planners, and it's changed over time, but still, it is a lot more men than women as professionals in our industry. But we've seen a huge shift over the last several decades, and I think there's a lot more women involved.
I think I've shared this with you before, but when I first got into business, which was 1986, and I would go to an E.F. Hutton event, there might be, out of 100 people there might be 2 or 3 women, maybe. Today, that's probably more like 25 or 30.
Yep.
So it's definitely changing, and there are actually, when we're looking for people to do things for us, like another advisor or a planner or something, there seems to be more women than men who are applying. Would you agree?
I think there's been a shift, definitely seen a shift. But as a whole, though, the industry, it's still more male-dominated.
Well, it is.
But you're right, there's a lot more women that are getting educated and wanting this pathway.
Right. It changes slowly. I mean, people want it to change on a dime. It just
They do. I
doesn't
want it
do
now.
Sound like my kids.
You're not that young. Yeah, it's the kids that want it now.
No, that's true.
I mean,
I'm not that young.
No, you're not the new generation that
it's
immediate
okay.
gratification.
We had a client over the weekend. We had our like a little summer event barbecue, and she was asking me my age, and I was like, okay, so
Stop it.
it was funny. I was like, oh, I am
Was
getting
she
older.
younger?
She was older than I am, but she didn't realize how I'm aging. So,
I think it's a good thing, Catherine.
I guess.
Well, we never know that. We had your daughter and my granddaughter
Yes.
at this event, and people were just amazed. When did they get to be so big?
Yeah, they're young women now.
I know. It was funny because a couple of clients came up to me like, are those your twins? And so I was like, no. Phoenix is the other twin to Madison. But I was like, because they see Hannah and Maddie together all the time. I was
Yeah,
like,
they're-
well, maybe the dark skin that Hannah doesn't have.
That's right. I told that to Hannah, as my granddaughter. I said, except for the skin color, you guys look exactly alike. Kidding, of course. So anyway, other examples of things that do-it-yourselves might miss is retirement planning. Withdrawal sequencing is important. You know how they do that. Perhaps Roth conversions. Most people, they know about it, but do they know enough to do it properly? Spending flexibility, longevity, and healthcare. Healthcare is another thing we talk about to a lot of people, and that's a big worry.
It is.
It is.
Well, especially also the long-term care planning and, what are your plans for the future? And that's definitely part of the conversation.
Yeah, I was talking to my clients that are selling their business. He's in early 60s, and between that and Medicare age, they're not going to have, earned income. They can really look at who's the IRA Roth guru, Ed Slott. It's like never let a tax bracket go to waste.
Yeah.
Fill that up. The lower tax brackets, make sure you fill that up with Roth conversions if you don't have the income, and get it out of that taxable account.
I agree.
So it can grow tax free for.
Just remember, the Medicare premiums do have a 2-year look back
2 year
period.
look back. Yep.
So
So
you
you
want to watch
got to
that.
be careful.
Yeah.
Which means what?
So there's basically a table of what you will pay for your Medicare premiums. If your income goes above a certain amount, you pay the next higher amount. They call it a surcharge. And if your income goes up even more, then you pay another surcharge, and so on. So I'm not sure exactly how many surcharges there are, maybe 4.
Yeah.
But
I think I'm on the 6th.
Oh, okay. So you definitely want to
You
watch your
added some more?
income if you're, and that's part of the planning that
That's
we do.
part of the
That's part of the
the
planning is
work
looking
we
at
do.
that. Mhm.
Yeah.
Right, and then something about tax efficiency, asset allocation, obviously,
Absolutely.
tax loss harvesting, which a lot of people don't really take advantage of or don't.
Or they wait until the very end of the year to take advantage of, but it's good to look at that mid-year.
Right, and I know we talked about this, I think, a week or two ago, about a company that has portfolio that they do tax loss harvesting
Throughout the year.
Yeah, throughout the year, and then capital gains planning. So there's a lot of things that. If all you're doing is putting your money into a S&P index or a Dow Jones index, that's fine. But what you're missing out on, of course, you don't know what you don't know. But what you're missing out on, I think, makes up for any possible fee that we charge. And the fees have come way down. I mean, again, going back to my roots here at E.F. Hutton, in 1987 or 88, I was one of the first ones that was actually doing what we called managed accounts, where an outside money manager was actually doing the stock or bond trading, and we got paid a fee. In those days, you could get paid 3%. Okay, now I never charged 3%, but I remember charging 2%. And today, the standard in the industry is 1%, but that's come down, and I think it won't surprise me if over the coming decade it comes down even further. So if you're talking about 60, 70, 80 basis points, that's not really a lot.
Not for what we're offering.
Exactly. Not for all the things that you might not know about.
Right.
I mean, we talked about this, I know, before, but it's worth repeating. We had somebody who had an annuity, and without talking to us, they
They got out of it.
They got out of
Yeah.
it, and it cost them a ton in taxes.
And of course, they came to us after they did it. I was like, oh no, it's hard to undo that.
we would have been able to save them
them,
that money, which would have taken care of fees for the next 40 years.
Yeah.
So,
Yeah.
So anyway, this is a little bit different, our talk today. It's not so much about markets in general. We're doing this on a Monday. Normally we do it on Thursday. And just to let you know, next week we will not be doing one. Partly it's because of our star, Catherine, is going to be out, and our star's husband, Jocelyn, who is the man behind the cameras, is also going to be out, and probably everybody else. So we're going to take a 1 week hiatus, and hopefully by then the tax bill will be
Yes, we'll have
done,
something to talk about.
and the market will continue. I mean, this is the halfway point. Despite everything that's happened, and there's been a lot, the markets are still okay. They're
Pretty resilient.
right. I mean, they're up a tiny bit. You know, the bigger stocks, the smaller stocks are down a tiny bit. Quite honestly, I think if by the end of the year we were still here, I think I'd be happy.
Exactly.
Because everyone's talking about how the markets are so overvalued, but right now, you know, we're just not seeing it.
So in the meantime, if you have any questions, feel free to give us a call at the office or email us. But we'll be back here to report to you on July 17th.
And if you know of people who might be advantaged by what we do, I mean, that's part of the reason we're here. You know, I talk about do-it-yourselfers, and you know, your kids who might inherit money, maybe they really should be taking some advice. So if you know of people who want to use us, please, you know, we love the referrals. You know, it's probably the highest compliment we can get.
Yes, exactly.
All right. So everybody have a great 4th of July weekend. Remember why we're celebrating our Independence Day from Britain. And for those of you young people that don't know that, that's why we're celebrating.
Yes.
And enjoy the food and the fireworks, and we'll see you in a couple of weeks.
Thank you.
Thank you.
Thank you.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.